right, future certified public accountants, welcome back. Are you ready for our next exciting topic in our adventure towards being a CPA? We got PP&E. Yeah, you know me. Let's do it. PP&E is also known as what? Fixed assets. First thing you got to notice about PP&E, the fixed assets, they're acquired specifically for what use in the business, not for resale. Okay, so we're talking about PP&E fixed assets for use in the business. Okay, these are long-term physical assets. All right, so non-current assets. And except for the land, these fixed assets will be depreciated according to the matching principle. Okay, so these assets have to be shown separately, whether it be on the balance sheet or in the footnotes. We've got to see these items at historical cost. So land, the property, whenever you see land, you immediately think no depreciation. Land improvements, you'll depreciate, but the land itself, no depreciation. Buildings, plant, a factory, a warehouse, an office building, or equipment, machinery, tools, furniture, fixtures, all that's going to be subject to depreciation. Now, don't forget, under U.S. GAAP, and for my friends outside the U.S. who are studying, we're not going to be doing any mark-to-market here. So in the U.S., these fixed assets are going to be shown on the balance sheet at using the cost method, your historical cost minus accumulated depreciation. Now, your accumulated depreciation, mind you, is a contra asset, credit balance. So if you take your cost, debit balance, and you subtract your accumulated depreciation with a credit balance, you get your net book value, your net debit balance, okay? So that contra asset accumulated depreciation, when we want to increase accumulated depreciation, we do so with a credit. When we sell off the asset and we want to get rid of accumulated depreciation, you'll see we do that with a debit. All righty. So historical cost. Now, there's different ways you could pay for that asset. Maybe you pay cash or the cash equivalent price. So sometimes you'll debit the PP&E, credit cash, sometimes debit PP&E, but credit a note payable. You've purchased it with debt. Okay, non-cash investing and financing. You get the PP&E, but instead of paying cash, you issue a note. Or non-cash investing and financing, sometimes you debit the PP&E and you credit stock. You issue stock, and we would use the fair market value of the stock issued, never the book value, the fair market value of the stock issued. So either pay cash, issue a note, or issue your own stock. So the cost of that asset is not just the invoice price, folks. It's obtaining the asset, the invoice price, but you got to include freight in, bringing it to its intended location, okay? So shipping, and then getting it whatever condition necessary, ready, get it in the condition necessary for its intended use, which I'll show you in a little bit. Now, there are situations where sometimes rich people like Tim Garrity donate fixed assets to a company. Like I think he donated my laptop to Becker for me to record this lecture. What would have been the journal entry on behalf of Becker, being that a fixed asset, piece of equipment, was donated? They would debit the fixed asset at fair market value as if they bought it, but they can't credit cash because they didn't pay Tim. So what would they credit instead? A gain. So when assets are donated, I need to know the fair market value. We debit that fixed asset at fair market value and then credit gain. Okay, and the gain would obviously go on your income statement. All right, land. Land is purchased for the purpose of building construction. Okay, it includes all costs up until, now you got to remember this, up to excavation. Excavation, which means digging the foundation. Well, when you start excavating, when you start digging the foundation, now you begin the cost of the building, which is depreciable. So the land is all costs up until, but not including the excavation, which is digging the foundation. Okay, that's when you start the cost of the building. Those costs will get capitalized and then eventually subject to depreciation. So when you buy land for the purpose of building construction, you've got your purchase price. You probably had to hire a realtor. There's probably a commission. Probably hired a lawyer to do a title search, recording any legal fees. Maybe you had to drain a swamp. What are you, in Staten Island? Drain a swamp. Maybe you had to clear some brush and trees, all part of the cost of the land. Now get this, site development. Grading the mountaintop, okay, filling in a hole, leveling. That's all part of the cost of the land. Don't confuse that with digging a foundation, which starts the cost of the building. Okay, sometimes you buy a piece of property and you assume from the buyer an existing mortgage or back taxes. That's all part of the cost. If you have to knock down an old building, That's part of the cost of the land. So if you've got to raise, knock down, demolish an old building, that's all part of the cost of the land. Now get this, you don't add this, you subtract this. If there's anything you can sell off from the land, like sale of an existing building, or you're able to sell off some of the scrap metal, whatever, or if there's any standing timber that you can then, sell off, that reduces the cost of the land, okay? The proceeds on the sale of existing buildings and standing timber. Do not confuse standing, I guess, with sitting. All right, when you see land improvement, you think depreciable, not the land. We know the land is not subject to depreciation, but any improvements to the land, fence, water, sidewalk, paving, landscaping, lighting, don't memorize. Just be familiar. The improvement to the land is subject to depreciation, okay? And sometimes we borrow money. I'll talk about interest costs during construction later. Okay, but that would be added, capitalized, added to the cost of the land improvement, and then subject to depreciation. Any interest costs which are normally expensed as incurred, well, when it's the magic words are during the construction, well, during the construction, those interest costs are capitalized. They're not expensed. They're added to the cost, in this case, of the land improvement, and then would be depreciated along with the cost of the building later on. Okay, the cost of the building, the plant, the factory, the warehouse, whatever it may be. You got your purchase price. Any deferred maintenance. Now, when you see repairs and maintenance, don't immediately think expensive, okay? That might be the general rule. But when you buy a building and there was deferred maintenance, so you've got repairs that were neglected by the previous owner, that gets capitalized and added to the cost of the building. That's not like ordinary repairs and maintenance on a building you already own. These were neglected repairs, okay? So note the difference there. An alteration, improvement, architect fees, digging the hole, excavating. Remember, that starts the cost of the building when you dig the hole for the foundation. Okay, that's part of the cost of the building versus filling in a hole or leveling or grading. Remember, that's part of the cost of the land. Construction period interest. Generally, interest is expensed as incurred, except when you borrow money to construct a building. During the term of construction, which we'll see again later, that interest cost gets capitalized, added with the materials and labor, and then we'll depreciate that later on. Folks, sometimes we have what's called a basket purchase. Somebody buys both land and then on top of the land, there's a building. Well, the buyer has to allocate the purchase price between the cost of the land and the cost of the building. Why? Because the land is not going to get depreciated, but the building is. So we're going to need a ratio of appraised value. So they'll tell you the basket purchase was for $1.8 million. But hey, the value of the land is $400,000. The value of the building's $1.4 million. $1.4 million divided by the total cost, $1.8 million. That's the percentage we'll allocate towards the cost of the building, okay? So if it's a basket purchase, we paid $1.8 million for the land and the building. They've got to give you appraised values for the land and building so we can allocate, all right? Because the building's got to be depreciated. If you're not ready for multiple choice, don't leave me. Come back. That was not enough, all right? Let's do some more stuff, and then you can do some multiple choice. But come back.